Welcome. Today, we're diving into the world of securities markets, focusing on the differences between primary and secondary markets, the key players involved, and the regulatory framework that keeps everything running smoothly. Whether you're an aspiring investor or just curious about how companies raise money and how securities are traded, this video will break down the essentials in a clear, approachable way. Let's start by understanding what the securities market is and why it matters for businesses, investors, and the broader economy. Ready to explore? Let's get started with the basics. The primary market is where new securities are created and sold for the first time. Companies or governments seeking to raise capital offer their shares or bonds directly to investors. This is the market where businesses get the funds they need to grow, innovate, or manage operations. Investors in the primary market are essentially buying directly from the issuer, making them the first owners of these securities. The process is highly regulated to ensure transparency and fairness, and it's a crucial step in the journey of any security before it can be traded freely. Early investors, such as promoters and private backers, play a vital role in nurturing a business during its initial stages. When the company is ready to grow further, these early investors can exit by selling their shares in the primary market. This exit is often profitable, as the business has matured and attracted public interest. The primary market thus provides a structured way for early supporters to realize gains and for new investors to step in, ensuring a healthy flow of capital and opportunity. Liquidity refers to how easily securities can be bought or sold without affecting their price. When only a few investors hold a company's shares, selling them can be difficult. But once securities are issued in the primary market and listed on a stock exchange, they become accessible to a wide range of investors. This listing opens up the secondary market, where securities can be freely traded, providing liquidity and flexibility for all participants. The primary market is closely monitored by regulatory authorities to protect investors and ensure fair practices. Every step, from issuing securities to disclosing information, is governed by strict rules. These regulations are designed to provide transparency, define the rights of all parties, and maintain a balanced environment. While there's no guarantee of returns, the regulatory framework aims to minimize risks and ensure that capital is raised ethically and efficiently. After a public issue, securities are listed on the stock exchange, allowing them to be traded among investors in the secondary market. The primary market is where issuers raise capital, while the secondary market provides liquidity by enabling investors to buy and sell securities among themselves. Importantly, trading in the secondary market doesn't affect the capital of the issuing company. Prices in the secondary market also serve as important signals for future primary market offerings. Activity in the primary market often depends on the trends in the secondary market. During a bull market, when prices are rising and trading is active, more companies are likely to issue new securities, taking advantage of investor enthusiasm. Conversely, in a bear market, when prices are low and trading slows down, it becomes harder for companies to attract enough investors for new issues. These cycles influence both the volume and pricing of primary market offerings. A range of intermediaries work together to ensure the smooth functioning of the primary market. These include merchant bankers, book-running lead managers, registrars, bankers to the issue, brokers, depositories, debenture trustees, portfolio managers, and primary dealers. Each plays a specific role, from managing the issue process to safeguarding investor interests and ensuring regulatory compliance. Let's take a closer look at what each intermediary does. Merchant bankers are central to the primary market process. They advise issuers on pricing, prepare issue documents, handle applications for listing, and manage the entire issue process. They may also act as underwriters, committing to buy unsold shares if the issue isn't fully subscribed. Their responsibilities are clearly defined in agreements, and they receive a commission for their services. Merchant bankers ensure that the issue is conducted professionally and in line with regulation. Book-running lead manager, or BRLM, is a specialized merchant banker responsible for key activities like due diligence, drafting the prospectus, ensuring regulatory compliance, and marketing the issue. The BRLM coordinates with other intermediaries and manages post-issue responsibilities, such as finalizing allotments and handling funds. Their expertise ensures that the issue meets all legal and procedural requirements, providing confidence to both issuers and investors. Registrars and transfer agents play a crucial role in maintaining records of investor applications and funds received during a primary issue. They help determine the basis of allotment and are responsible for processing and dispatching allotment letters and refunds. Share transfer agents also manage records of securities holdings and handle transfers and redemptions. Their work ensures that every investor's transaction is accurately recorded and processed. Bankers to the issue are appointed to manage the financial flows during a primary issue. They accept applications and funds from investors and handle refunds for unsuccessful applicants. These banks maintain daily records of all transactions, ensuring transparency and accountability. Their involvement is essential for the smooth and secure handling of investor money throughout the issue process. Brokers act as the link between the issuer and prospective investors. Their main responsibility is to procure subscriptions for the issue, helping to ensure that the securities are fully subscribed. Brokers use their networks and expertise to reach a wide range of investors, making them an important part of the primary market ecosystem. Depositories hold securities in electronic form, making transactions faster and more secure. The process of converting physical certificates to electronic form is called dematerialization. Depository participants, or DPs, act as agents of the depository, providing services to investors. While the depository becomes the registered owner, investors remain the beneficial owners, enjoying all rights and benefits. Debenture trustees are appointed to protect the interests of debenture holders. They ensure that the assets backing the debentures are sufficient and call meetings of debenture holders when needed. Their role is especially important in the event of a default by the issuer, as they act on behalf of all debenture holders to safeguard their claims. Portfolio managers advise clients on investments or manage portfolios on their behalf. They can be discretionary, making decisions independently, or non-discretionary, following client instructions. Portfolio managers tailor investment strategies to each client's needs, helping them achieve their financial goals while navigating the complexities of the securities market. Primary dealers are licensed by the Reserve Bank of India, RBI, to act as underwriters for government securities. They subscribe to government securities at auctions and resell them in the secondary market. Their agreement with the RBI defines their obligations, and they receive a commission for underwriting. Primary dealers play a key role in ensuring the success of government security issues. Except for primary dealers, all intermediaries in the primary market must be registered with the Securities and Exchange Board of India, SEBI. They are required to follow a strict code of conduct under SEBI regulations. This ensures that all participants act ethically and professionally, maintaining trust and integrity in the market. Not all primary market issues are public. Companies can issue securities privately to select investors, such as promoters or institutions, or make preferential or rights issues to specific groups. Public issues are open to anyone eligible, while private placements and preferential issues target specific investors. Rights and bonus issues are offered to existing shareholders, allowing them to buy more shares or receive additional shares for free. A public issue is when securities are offered to the general public, and anyone eligible can invest. This is the most common way for companies to raise large amounts of capital. Public issues are highly regulated, with detailed disclosures and strict procedures to protect investors and ensure fairness throughout the process. Private placement involves issuing securities to a select group of institutional or eligible investors. This method is often used for large, wholesale issues and can be faster and more flexible than a public issue. However, it's not open to the general public and is subject to different regulatory requirements. A preferential issue is when securities are offered to a specific set of investors on special terms. This can include promoters, strategic partners, or employees. Preferential issues can be made alongside public or private issues, providing flexibility for companies to structure their capital raising according to their needs. Rights issues allow existing shareholders to buy additional shares at a specific price, while bonus issues grant extra shares for free. These methods reward loyal investors and help companies raise more capital or distribute profits. The offer is made to shareholders as of a specific cutoff date, ensuring fairness and transparency. Investment bankers play a pivotal role in structuring primary market issues. They determine how much to offer to each group of investors, set prices, and ensure compliance with regulations. Their expertise helps companies navigate the complexities of capital raising and ensures that the process is efficient and successful. Issuers in the primary market include central, state, and local governments, public sector units, private companies, banks, financial institutions, mutual funds, and investment trusts. Each issuer has unique needs and structures, from government bonds to equity shares and mutual fund units. The issuer is responsible for meeting all obligations related to the securities they issue. Central, state, and local governments issue bonds, treasury bills, and sovereign gold bonds. These instruments often carry government guarantees and are issued only in domestic markets. Public sector units may also offer equity shares to the public as part of disinvestment programs. Government securities play a key role in the financial system, offering safe investment options. Private sector companies issue equity shares, preference shares, bonds, and other instruments to raise capital. They may also issue securities in international markets. These companies rely heavily on the securities market for funding, and their offerings can include innovative structures like convertible bonds and securitized paper. Banks, non-banking finance companies, and financial institutions issue a variety of securities, including equity, bonds, and certificates of deposit. They often have access to public deposits, so their dependence on the securities market is lower. However, they may issue long-term bonds or preference shares to strengthen their capital base. Mutual funds and investment trusts raise capital by issuing units for specific schemes. These schemes can be open-ended or closed-end, and the capital is used according to the scheme's objectives. Investment trusts, such as REITs and INVIT, issue units only in domestic markets and are structured to meet the needs of specific investment projects. Both retail and institutional investors participate in primary market issues. Retail investors are individuals investing up to a certain limit, while institutional investors include banks, mutual funds, insurance companies, and foreign portfolio investors. Each group has different approval processes and investment strategies, contributing to a diverse and dynamic market. Retail investors are individuals who invest smaller amounts, typically up to Rs. 2 lakhs in a single issue. Non-institutional buyers (NIBs) invest larger sums, while qualified institutional buyers (QIBs) are large institutions with internal approval processes. Foreign investors can also participate, subject to currency regulations. The offer document specifies who can invest in each issue. The primary market is regulated by several laws, including the Companies Act, Securities Contracts Regulation Act, SEBI regulations, and the Government Securities Act. These laws set out who can issue securities, what information must be disclosed, how funds can be used, and how investors are protected. The regulatory framework ensures that the market operates fairly and efficiently. Make a public issue. A business must have a legal structure approved by law. Detailed information about the company, the securities offered, and the risks involved must be disclosed to both the public and regulators. These requirements help investors make informed decisions and maintain trust in the market. Regulations ensure that investors' rights are clearly defined and protected. This includes fair procedures for raising capital, accurate information, and mechanisms for investors to evaluate and exit their investments. While returns are not guaranteed, the framework aims to balance the interests of all parties and maintain market integrity. Wrap up: the primary market is where new securities are issued, providing capital for businesses and investment opportunities for a wide range of investors. A network of intermediaries and a robust regulatory framework ensure that the process is transparent, fair, and efficient. Understanding the roles of different participants and the types of issues and investors involved is key to navigating the world of securities markets. Thanks for joining us on this journey through the primary and secondary markets.